All right. Welcome, everybody, to the Global Asset Strategies discussion. My name's Andrew Stotz, one of the guru ports at InvestX. And today I'm going to review some of the performance of the portfolios, but also take your questions about strategy into 2023 and try to explain to you some of the things that I'm seeing in the markets, whether we're looking at commodities, what's happening with gold, what's happening with oil, where should we be positioned? I'm going to cover all of those things throughout today. So feel free to ask any questions as I go through the presentation, and I will get started and go through it a little bit right now. So let's get started. First of all, these are the global asset strategies, and I'm going to walk through a little bit of a review, but remember to ask questions in the chat and I'll answer them at the end. So feel free to ask any questions as I go through. Some questions I know I'm facing right now is what's going to happen with interest rates? What's going to happen with the Fed? What's going to happen with commodities? What about war in Ukraine and Russia? And what about the US and China? And what about supply chains? What's going to happen? And what about GDP growth? Is it going to collapse in America, or is GDP growth going to rise? What's going on there? And will the Fed tighten further? And what does it mean? So we'll be going through all of those different topics tonight. And I hope that I can answer any of the questions that you may have. So let's get started, and I'm going to go into the presentation, and I'm going to just review a little bit about what happened in the last month or so, and then I'll look at the performance of the different strategies. I develop these strategies and bring them to you as guru reports at InvestX so that you don't have to do all the work. You can work with InvestX to follow these strategies. Then I'll talk about the global outlook that guides our asset allocation. And then I'll talk to you about the new weights for each of the three strategies. So let's go and talk about what's been going on. World stocks have taken a hit in 2022, but they gained in October and November. So world stocks were up about 19% in 2021, and they were down about 14.6. Actually, when you think about it, 14.6 is pretty small, right? 15% decline. It's not like it was a terrible year. For those people in Thailand who remember the 90s, 1993 was the peak of the Thai market. The market peaked at 1789 as the set index at that time, and it fell by more than 90%. That is a real fall in the market. So actually 2003 turns out to be a rough year, but not a terrible year. So the market recovered on expectations that central banks will slow the rate hikes. Now, bonds were up in November, and in both the global asset enhancing strategy and the global alpha asset strategy. Rather than global bonds, we have a target allocation to Thai money market, which was flat as expected. So we didn't experience the complete collapse because that happened at the beginning of the year, and Thai money market bonds tend to be pretty smooth. So the main purpose of our money market allocation is downside protection. So though we try to make gains on the upside when in bonds, the reality is that we are generally trying to protect the downside if the market crashes. Let's continue on and look at commodities. Commodity funds were up slightly in November, and gold gained about 6% in November. And gold closed the month at about 1,768 per ounce. A weaker dollar was the main driver of gold's performance. So now let's look at the performance review and see where the strategies are at. First of all, I'm showing the performance until the 19th of December. This is the Global Inflation Plus strategy. And this strategy, of course, is low risk. And it's pretty much behaved low risk. You can see that the strategy has been flat over this period of time. Now, the strategy was up by about 0.9%, but 2.5% less than the 40 equity 60 portfolio. And that's because we can see that equities have done relatively well. Now, the global equity fund we use in the strategy had a weak performance in the past month, which led to some of that underperformance. We would like to have gotten more performance, but you can't win every time you invest. And that's a lesson that I've learned over the years. You've got to take a long-term view and try to stick to your strategy. And I would say that one of my strengths is that I stick to my strategy. I don't get caught up in all the excitement of the day. Now, let's look at the global asset enhancing strategy, which was up by 4.2%. So here we can see the global asset enhancing strategy, and basically the performance is kind of flat over the period of time. And we can see the strategy was on par with the 60-40. It was up 4.2% in the month of November. Let's review our allocations. We have 25% allocated to gold, which was the fourth best performing asset. And unfortunately, we didn't perform that well with our commodities and our bonds exposure. But, part of the strategy that I think about nowadays is there's so much uncertainty. And I would say that the upside potential on the equity market is kind of low. Like, it's not like we're going to have some massive bull market coming. So I would rather lose a little bit and be defensive than try to bet and try to gain something when I think that there's big risks in the market. So I'm willing to walk away from some of the gains in order to protect the downside in a volatile time. So let's look at the global alpha asset strategy, which was up as 4.4%. So here we can see that the global alpha asset strategy is about flat over that period of time. And the strategy was also above the world equity since inception. The strategy was 1.5% above the world equity as of the 19th of December. So let's look at the performance. Here we can see the strategy was about 0.5% above the 60-40 portfolio. And the strategy was 2.8% below the world equity portfolio, which did very well in this case. As world equity has rebounded, our bigger tilts to world healthcare and bonds dragged on the performance. So what's the outlook? Feel free to ask any questions as I go through. I'm happy to answer any questions that you may have. And now it's time to really look at what's the outlook for the future. I think that 2023, let me just come in, maybe I can come in full screen and talk to you for just a moment, because 2023 is a challenging time to invest. I think there's a lot of questions, such as, will the Fed continue raising rates, or have they done enough and then they're going to come down? Or could the U.S. economy collapse, or is it going to stay steady? Or what about tech companies? Tech companies' profits and tech companies' profits have not come down nearly as much as their share prices. So are we going to see more of that? Is it time for value to outperform growth? Well, that's happening right now. Let's go through some of these ideas and try to see what's going on. First, equity. Now, inflation has started to turn. This is a global or world inflation that I calculated by weighting the size of the economy of every country in the world, and then using that weight times their level of inflation. So though a small country may have a very high inflation, it's a small impact on the world inflation. But here we can see that inflation and the 10-year bond is starting to cool off. So part of that's driven by oil prices, which have come down substantially. So higher prices reduce demand, and a higher base is also likely to reduce the inflation rate. So inflation could be close to the peak, even without central bank intervention. Now, the next Fed meeting is on the 1st of February. And right now, a Fed rate hike is priced in. Basically, the market is pricing in a 100% certainty of another Fed rate hike at the next FOMC meeting in February. The implied probability is 73% for a 0.25% hike to a target rate of about 4.5 to 4.75. And what you can see is that basically the market is expecting that the Fed is slowing down. They've finished most of their rate tightening. Now here, what we can see is that since March, there's been aggressive market expectations have shifted to a much more aggressive Fed, but the market is expecting, let's say, 4.9% or so for the peak in the Fed. That's mid-2023. So the market expects mid-2023 for the Fed to be at about 4.9. A Fed is aggressively tackling inflation, which raises the risk of causing a massive recession. In fact, that's what Chairman Powell said he wanted to do, was he wanted to basically have interest rates rise so high that they could cause demand to fall. And what demand falls means is that we are in some sort of recession. So I think that it's very likely that we end up in recession in 2023. Now, the market expects the target rate to peak at about 5%. Here we can see that consensus estimate is that peak, and I put the red line in there to basically highlight that currently market participants are betting on a peak rate between March and July. So let's just think about it. What that would mean is a recession potentially coming in mid-2023. It could mean that the Fed starts to reverse and lower rates. And basically, the mid of next year is a key point. So now let's look at another chart that I made. And this chart shows the amount of time that the Fed has left the interest rate at the peak. So right now we're saying the market's saying a peak of about 5%. On average, they have left the interest rate at the peak for about 6 months. And so I've made that in this chart where you can see the dotted line. Let's look at that for a second. I'm going to grab my pen and just highlight that. And here we can see that we've got a huge, fast increase in the federal funds rate, faster than almost any other increase. I think this one was pretty close, but still not as steep as the rate increases that we're seeing. Our expectation, if we follow the past, is that it would sit for about 6 months at that level. So that means that it would sit there throughout most of 2023. Now, during the dot-com bust, the Fed kept the peak rate up there for 8 months, and during the global financial crisis for a record 15 months. Now, based on the 6-month average, you could expect that the Fed is going to start to reduce rates in about September. So let's just say about mid-year, we could see weakness in the economy, and we could see that the Fed starts to turn towards September, third quarter. Now, of course, the market moves before the economy, and we've already seen, a fall in the market. And I would argue that we probably are going to see a further fall in the market, maybe for the first quarter, could even be into the second quarter. And then what we'll see is the bottom for the market, not yet the bottom for the economy. So let's look at the economy. I'm talking about a recession in 2023. Why do I say that? Well, I say that for many reasons. I mean, the first reason is that the Fed has increased interest rates so fast that it's got to slow things down. But what we can see here is that the yield curve inversion basically is the points on this chart where I've drawn a circle. Basically, all recessions in the U.S. since 1970 were preceded by an inverted yield curve. And you can see the latest one is pretty deep compared to the prior ones, all the way back to, let's say, 1978 or so in the past was the other time that it went this low. The average time from inversion until the recession started was about a year. So again, that tells us recession starts mid-2023. These are some of the reasons why I see a tough time, particularly in the US. Now, valuations have come down, but that's primarily due to a price fall. If you look at the red line here, what you can see is that it's about 20 times PE at the peak. And then now it's come down to about, let's say, 14 times or so, getting close to 14 to 15 times. And that tells you that we've definitely had a strong D rating. However, look at the blue line. What you can see is that the net profit margin, and this is the forward, so this is analyst forecast, the net profit margin is still damn high. I mean, look at, it was as high as 11% at this point, and then we've had a small fall to about 10.5%, but that's far away from where it's been in the past. Look at it, 2008. It got all the way down to this period, which would be about that period is on the right-hand side. That's about 6% or so. So we have some ways to go down on this net profit, and that means earnings downgrades by analysts. So let's look at that for a second. And here's a chart that I did to try to understand what are the consensus estimates for earnings growth. And what you can see is that for this year, not bad, 6% is pretty good. But next year, they're expecting about 5%. Of course, analysts are expecting that things bounce back to 10%. But I would argue that it's quite likely that we could see the EPS negative, or the EPS growth negative. In other words, if they had 10 baht or $10 in earnings, the next year, let's say they have 9, they've had a 10% fall in their earnings, so negative, but they're still making a positive earnings. So I think that we still are a long way away from analysts adjusting. Now, behind me, I have my books here, and one of the books there is my dissertation. And my dissertation for my PhD was a research about the accuracy of analysts. And what I found was that analysts are wrong by about 25%. They're optimistically wrong. They're overestimating. And then, things get bad. They feel shocked, and then they downgrade. Also, what's pretty clear is that analysts have a hard time forecasting the changes in the trend. So when we see things collapse, analysts don't normally predict that. And I would argue that from the research I did for my PhD dissertation, as well as from the research I do now, it tells me that analysts still haven't downgraded. And then to say they're going to be 10% growth in 2024, maybe, but I would say that's pretty aggressive. So let's look at what's going on right here. So let's now look at developed Europe. And what you can see is that it's very high consensus for 2018. Part of that is a base effect because the prior year was really low. But once you've got a really high amount there, now all of a sudden we're down low. And again, I expect that analysts would probably downgrade further because there's more to come in Europe. And let's look at Japan. Japan, also a big downgrade expected, or a big much, much lower level of growth. We're talking about 1% growth there for Japan. And let's look at emerging markets. That's the EM here. Emerging markets have a little bit higher growth than the US market. We can see a little bit higher growth expected this year, but you can see that it's much lower growth here. I think that expectations for emerging markets profitability is relatively low because there's so many other factors, particularly currency. And let's now look at the Asia Pacific region. And what we can see is that, we didn't get a big rebound in 2022 earnings, and therefore we're also not getting a huge fall in this period. Now, there's another reason to look at Asia compared to other parts of the world. The thing about Asia is that the PE multiples of Asia have not been that high for a while. Also, keep in mind that in Asia, generally we have floating interest rates, okay, outside of Hong Kong and Singapore. Take Thailand as an example. We have floating interest rates. What does that mean? That means that the government cannot save the economy and businesses in Thailand. Why? Because if they started printing money to try to give to people, what would happen to the currency? It would crush the currency, and speculators would bet against the currency. And therefore, the free floating exchange rate is a great market, let's say, it controls the central bank. And most countries in Asia have floating exchange rates, which means they cannot mess around too much with injecting a lot of liquidity or that type of thing. Now, the US has injected more liquidity than anybody, but it's the reserve currency of the world. So even when they inject liquidity, it doesn't impact the US dollar. In fact, I would say that the US dollar gets stronger. US dollar gets stronger almost no matter what happens. Now, that's not going to be forever. I think the US dollar is going to start to show some weakness, but right now and during times of crisis, we can see that the US dollar has some risks. Now, for the past year, we've said that we think the course will eventually be reversed. What do I mean? Well, we still think central bankers and politicians will change course and return to accommodative policies as soon as something breaks. And we do think that central bankers are going to break things. I like to think about the central bankers and think about what is their experience and skill at setting interest rates, really setting the price of money. Would we accept if the government set up a committee to set the price of an iPhone? What about the price of a computer? What about the price of a car? How do you think committees would do at setting these things? But yet we allow the Fed to set the price of money. Kind of ridiculous when you think about it. And when you think about it, the Fed chairman was wrong when he said that it was transitory inflation and he didn't increase. And then later he increased. And then when Janet Yellen said there won't be a recession, I think that we're going to see a recession. Now, central banks may kill growth, but not inflation. And if that happens, it's stagflation. It's typically bad for both stocks and bonds. Now, commodities have typically done well during inflationary times and have been resilient during stagflation. Gold has historically fared well during stagflation. Now, I would like to talk just briefly about the concept of commodities, because if you think you're having stagflation, commodities should perform well. Really, commodities perform well in two circumstances. Number one, unexpected inflation. That's what we got, and commodities went up. And the other one is stagflation, when everything's falling, the economy's falling, but inflation still remains high. And when it's a stagflationary period, bonds tend to do very well. Or sorry, not bonds, commodities tend to do very well. And so part of the reason why I have commodities in my portfolio is to protect against the potential of the stagflation happening. Now, let's look at bonds. Bonds are typically a safe place to be, even though 2022 has been exceptionally bad in the beginning of the year. That didn't hit us because we started these portfolios along after that. In recessions, safer assets like government bonds are typically performing well. Though with high inflation, low yields could still lead to negative real returns. We typically don't allocate the bonds to speculate on the upside, but rather to use it as a way to protect capital over time. Now, next, let's talk about commodities. The market expects natural gas price to rise during the winter in Europe. In fact, it's incredibly volatile. As you can see, natural gas prices spiked up to almost 950 on an index where we indexed at 100. And then it collapsed, and now European natural gas ran back up. Now it's coming back down a bit. But I would say a long, cold winter is going to continue to put upward pressure on European natural gas. So Europe's Russia gas dependence influence prices. And if the weather gets colder, gas storage can quickly deplete and prices could rise further. There is some fundamental support for energy prices. OPEC Plus keeps missing its output targets, and the cartel has announced to cut production and support oil price. Ukraine war could lead to further supply shocks, and energy prices could also remain high due to past underinvestments in projects. Let's talk about that for just a moment and look at energy prices. What I would say in this case is that there's really a mad craze in the world, which is called ESG investing. Now, of course, everybody wants the world to be a better place, want to have a better environment. That's the E. Want to have better social systems. That's the S. And better governance of the companies. G. However, what's happening is that ESG is using its tool to hold back funding from certain industries. So what's the industry they've held back funding from? The oil and energy industry. And what's happening now is that right now, as demand rises for energy, we will see that price tends to rise. Now, right now, oil prices are low, but I expect that we'll see them rise a bit more. Now, of course, I do expect a recession in 2023. And with the recession, we get falling oil prices. But I also think that the Saudis, and we've recently seen the Saudis do a deal with China where they're trying to sell oil from Saudi Arabia to China using Chinese yuan, the Chinese currency. That is a first because it always in the past had to go through the US dollar. This is called the petrodollar. Now, it'd be interesting how the US reacts to this whole thing. But if I was the Saudis, I would say, hey, you told me ESG, you don't want to buy any more oil. So I'm selling my oil to somebody else. So ESG, I think, will have a strong impact on keeping oil prices high over the long term. Now, supply for agricultural commodities could tighten further. Right now, what we've seen is price of food did go up quite a bit, but now it's kind of stabilizing on this chart after spiking. So I would just expect that right now we'll probably stay flat. Supply for agricultural commodities could tighten further. La Nina could reduce the supply of important commodities like corn and soybean and wheat. Now, commodities have some fundamental support. Demand for necessities like food and energy, inflation, and supply chain disruptions related and unrelated to the war in Ukraine are going to keep commodity prices high. A reopening of China could lead to increased demand for commodities. Also, if we were to go into a stagflationary period, commodities should show resilience. And that's where I think the commodities positioning in the portfolios partially is trying to capture the stagflation period if it happens. Now, this is an interesting chart, which comes from the World Gold Council, and I recreated it here. It shows that central banks have been loading up on gold, maybe switching from US dollars. You can see that for the year 2022, so far, gold demand has been about 782 metric tons. And that's double what it was in 2021. So central banks are loading up. And what does that mean? It means that oil prices starting to rise. And we can see a little bit of a rise in oil price that we've gotten recently. And I would say that to me, not oil, gold. Some people call oil black gold, but gold prices are rising a bit. And I would say that I'm generally long-term bullish on gold. Why? Because governments mess things up. And I think the US government is messing things up. And what could happen is that they overborrow and we end up in a very difficult situation. Now, the war in Ukraine spurs uncertainty and inflation expectations could rise, making gold attractive. Though expected rate hikes are negative, in general, gold protects value in market downturns. So again, let's take a step back. We want to try to capture the upside in the stock market. We also want to try to avoid massive downsides or drawdowns. Gold and bonds in particular are a great tool to try to reduce the amount of drawdowns in the portfolio. And that's a big reason why we have it and why we have a 25% weighting because of the risks in the market. So the key takeaways are central bankers appear to be raising rates into a recession to stifle inflation. Stagflation could be the worst outcome. And demand for necessities like food and energy, inflation, and supply chain disruptions can drive commodities higher. Bonds and gold are in the portfolio to protect capital. Of course, we're happy if they rise, but ultimately they're there to protect when the stock market falls. All right, it's now time to announce our new allocations. Ladies and gentlemen, let's go through that. For the global inflation plus strategy, this is our lowest risk strategy. Try to protect the value of assets. You can see that we keep equity at 30% and we just reduce tips a bit. We move 5% to world healthcare from world infrastructure. We consider both defensive, but healthcare has been more defensive this year. And we reduce the inflation-linked bonds to 10% from 15%, and we raise Thai medium-term bonds by 5%. Very small adjustment, but a key thing is if we don't have as high inflation, tips are not as necessary. Here we can see that Thai inflation may have peaked like we've seen globally and like we've seen in the US. So we reduced that inflation-linked bonds to 10% from 15%. So let's talk about the risks of this strategy. The risks of this strategy are actually pretty low because this strategy is inflation protection, mainly bonds. So, but if rate hikes push down bond returns, well, we're mainly exposed to Thai bonds. Hence, the Bank of Thailand's actions impact the most. Central banks' aggressive rate hikes and QT could crash the market. If that happens, it's going to hurt a portion of this strategy. And collapsing energy prices would be damaging since we have exposure through our 5% allocation to world energy and commodities. Now, you'll notice in this strategy, we don't take huge positions in what I would consider to be riskier assets like equity, energy, and commodities. We do have some of that in the portfolio because we need the upside, but we don't take big bets. So now let's look at our moderate risk strategy, the global asset enhancing strategy. And for this one, we make no changes. Basically, we remain underweight equity and keep 25% target allocation in each asset class. That means 25% allocated to equity. Now, our maximum for this strategy is about 85% allocated to equity. So you can tell that we are very defensive. In addition, we break it down and show you right here that only 5% of the equity portion of the whole portfolio actually is devoted to the US. So we are very underexposed to the US. Within equity, we have a 5% minimum allocation to each region. So what are the risks here? Well, inflation quickly gets under control. That could be a big risk to the positioning that we've done in this strategy. Central banks, aggressive rate hikes, and QT could crash the market. Well, we have exposure to market. You can see it's pretty low right now. We're underweight equity. So if central banks pivot and stocks go up, we'd miss that upside if it just happened in a short period of time. And weak Chinese economy could reduce commodities demand, and that leads to lower prices. So we could get it wrong on the commodities, and other commodities could fall with energy prices too, as it's part of the production costs. Now let's look at the global alpha asset strategy, which is our highest risk strategy. We've made some big changes here. We've increased equity allocation to 73% from 63%. We've increased world energy and we've added back India. We've reduced healthcare and infrastructure and we got out of US equity, again, taking a defensive stance there. We reduced bonds to 2% and gold to 3%. And we raised commodities to 22% from 4%. So from a momentum perspective, we do see some opportunities in commodities. So let's talk about our 22% tilts. We've already covered commodities and talked about energy prices. But let's look at one more chart related to our 22% tilt to world energy. Here's a chart that's interesting. It shows two lines, S&P crude oil spot. Well, This is an oil product by S&P. So meant to track oil price. And we can see oil price coming down since mid 2022. The next one is KTAM World Energy. And here you have a mutual fund that's outperforming oil, even though it's an energy company. And what's happening there is that the energy companies have been making a lot of money, and that money is reflected in the perception of the funds out there. And I think that the funds are also perceiving that these companies are going to make more and more profits relative to just oil price, right? They're not just driven by oil. In fact, if you look at the oil, the energy companies, you'll see that their price of their product goes up and down a lot. Oil goes up and down a lot. However, the gross profit margin does not. So the oil companies are really good at maintaining their profits. And this, I think recently we've seen that profitability of energy companies has risen. Now we do have a question I see. You say you have Thai bonds. How about Thai stock market? Well, because in this strategy, the only strategy that we would potentially tilt towards Thai market is this one. So here we can see our strategy for the global alpha asset strategy is the only one that we would tilt. The other two, we wouldn't tilt towards one country like that. And here right now, you can see two countries, India and US. So what you see is that in order for us to tilt to the Thai stock market, we've got to really see that it looks great relative to many other countries, such as India, or maybe it's Vietnam or other countries. So for right now, I would say we're pretty much neutral on the Thai market. Momentum has slowed down. The valuation is a little bit expensive. So as a result, I'm kind of neutral on the Thai market. And, ultimately, you're not investing through me to get exposure to the Thai market anyways. You probably already have your own, as well as other funds that are your favorites. So that's why I try to stay focused on the global aspect. So let's look at India for a moment. Indian stocks have held up well in this year's turmoil. By the way, keep asking questions. I see that we've got some questions. I'm happy to answer those questions right at the end of the presentation. Indian stocks have held up well in this year's turmoil. We think India can outperform the world stock index, so we have a 22% target weight there. Remember, with this strategy, we are able to take some big bets. India is poised for continued growth, where Indian tech companies and infrastructure investments should be important drivers. The new Indian government budget is focused on infrastructure, renewables, and healthcare spending to continue fast GDP growth. And continued budget deficits should instill some confidence in the fact that the Indian government is going to support the market. Of course, the strategy with this more aggressive, or the risk to this more aggressive strategy, is that global recession could push stocks down. Central banks' aggressive rate hikes in QT could crash the stock markets. Also, collapsing energy prices would be damaging since we have high exposure to our 22% allocations to world equity and commodities. The strategy has a 22% tilt to Indian equity, so the strategy would be negatively impacted if the Indian market were to crash. I like to review all of the risks just so that we're thinking about these things as we're investing. So I just want to wrap up the formal part of this presentation by highlighting that we have three strategies. The global inflation plus strategy is low risk. The global asset enhancing strategy is moderate risk. And the global alpha asset strategy is higher risk. We tried to do this so that it depends on where you are at in your own opinion right now in the stock market. So let's take some time. And if you've got any questions, feel free to let me know and I will try to answer them. Jarvis says, how many percent of SEB comp fund that I should have in my port next year? Well, it depends on how aggressive that you want to be. Now, I do want to mention that commodities is generally not a great long-term investment. If you look at the performance of the stocks of equity over a long period of time, you're going to find something like 10% average annual return. But if you look at commodities, depending on the period you pick, you're going to find about maybe 2%. That's because commodities don't have some underlying cash flow generating ability. You're just trading a price that does have some intrinsic value, but you're ultimately trading a price. And so you want to be careful not to have too high of a weighting in commodities. I would say a 25% weighting is probably a maximum, because also the volatility of commodities is high, and the volatility of commodities is it's correlated with the stock market by about 70%. So the end result is that you're kind of doubling up on equity exposure. Now, we spend a lot of time, and myself and my team, looking at these strategies, thinking about them, and then picking our strategies of how we want to position the portfolio. And so I'm willing to go relatively high on the commodities, but I would say you may be careful. Now, if you've got plenty of risk appetite, you could go up as much as 25%, but I wouldn't go further than that. And truthfully, you may want to do a little bit less than that. Of course, talk to an advisor. Remember, I'm not an advisor. I am providing these strategies to InvestX and to their research team that then goes through it and gives me feedback and discussions before they bring it out to you. So always talk to an advisor about it. All right, Nan says, what US or EU energy company you like most in terms of great company with good values? I think Equinor is the one that I've done the most looking at, and I think that company has been pretty interesting. You know, you have to be careful with energy companies, though. It's a roller coaster ride, right? They're highly volatile, so just be careful with that. All right. I see another message from Jarvis, and it says, John Andrew Hart. Thank you. I appreciate that. And I don't know what it says in Japanese, but I'm guessing it says something like that. All right. If there's any more questions, feel free to ask, and I'm happy to answer those questions. Hopefully we've covered a lot of stuff and a lot of charts and graphs that hopefully can help you think about the market. And maybe what I'll do is wrap up this discussion by highlighting again that we have three strategies that we do through through InvestX. And these three strategies, maybe I'll just show it on the screen, the global asset strategies that we're doing with InvestX. First is the low risk global inflation plus strategy. The second one is the global asset enhancing strategy. And the third is the global alpha asset strategy. All of these strategies you can get through InvestX. You can talk to the staff there and get some guidance, work on the app and go through it. And you can always ask questions to the team there at InvestX as well as to myself. And I'm happy to try to answer those. Also, remember that I try to go live every single month here at InvestX. And so I'll be here to answer your questions and hopefully to help you as you're thinking through your own strategies and your own investments. I want to thank everybody for attending, and I appreciate your questions. And I think at that point, I'll call it a day. I hope that you have a great evening ahead and that you'll have a relaxed evening. And most importantly, that you set a long-term plan for investing. Stick with that plan for a long period of time. Don't get shaken out of the market. Stay focused and let those assets grow. Remember, Warren Buffett really got rich because he left his money in the market for 70 years. So let the power of compounding work for you. Trying to get in and out can be very painful and very difficult. This is Andrew Stotz, and I want to thank everybody for joining this InvestX presentation. I hope you have a great evening.
เราจะมาลงทุนกูรูพอร์ตโฟลิโอกันครับเลือกเมนู Intelligent Portfolio เลือกกูรูพอร์ตโฟลิโอเลือกแผนการลงทุนของกูรูที่เราต้องการลงทุนเราสามารถศึกษาข้อมูลของแผนการลงทุนและสัดส่วนการลงทุนได้โดยเลือกปุ่มเมนูข้อมูลแผนและสัดส่วนการลงทุนครับเริ่มต้นการสร้างพอร์ตการลงทุนเลือกแผนนี้จากนั้นตั้งชื่อแผนการลงทุนระบุเงินลงทุนก้อนแรกกรณีตั้งลงทุนแบบรายเดือน DCA กดปุ่มเปิดและระบุวันที่และเงินลงทุนรายเดือนได้เลยครับเสร็จเรียบร้อยแล้วกดปุ่มถัดไปจากนั้นตรวจสอบข้อมูลแผนการลงทุนแล้วกดสร้างแผนการลงทุนเพื่อไปหน้ารายการสั่งซื้อตรวจสอบรายการคำสั่งซื้อกดยืนยันรายการคำสั่งซื้อเพื่อส่งคำสั่งซื้อครับใส่รหัสพิน6 หลักเมื่อส่งคำสั่งซื้อสำเร็จแล้วจะแสดงหน้าจอส่งคำสั่งซื้อแล้วท่านสามารถตรวจสอบประวัติคำสั่งซื้อโดยตรวจสอบที่ประวัติทำรายการสัมผัสประสบการณ์ใหม่ของการลงทุนดาวน์โหลดแอป InnovestX ได้แล้ววันนี้